Hi everyone, Joshua Steger here from ETFadviser.com.au, and today I'll be looking at the Vanguard ETFs and give you some tips and tricks and a bit more information about Vanguard and how an advisor would look at Vanguard in terms of ETFs. So the first place to start was just looking at Vanguard. It's actually a little different to other fund managers in the sense that it's when it was first set up, it's actually a company that is owned by its own funds, so it doesn't have shareholders. It's not a listed company, so it's quite different in that regard in terms of its structure. So in theory, it should be able to provide lower investment fees because ultimately it's working for the funds, and the funds are, people invest in the funds and the funds own Vanguard. So it should be, in theory, help them to lower the costs and provide, really good investment options for investors. The next place to look at, and I wanted to show you, was Vanguard is actually, I'll just get this out of the way. Vanguard is actually the largest provider of ETFs in Australia, and the ETF market, we'll just go up here, is about 381 funds, about $250 billion in ETFs in Australia at the moment. You can see that growth over the last 6 years, and it's pretty exceptional actually. So the market's really firing. Something else to keep in mind, the biggest asset class in terms of ETFs is global equities, and that makes sense because people are using ETFs to get access to what they can't get in Australia. But the second largest, and still taking up a bit over a quarter of all the assets invested in ETFs, is still Australian equities. So that's something to keep in mind. So remember, $250 billion is the amount that's invested in ETFs in Australia, and there's about 381 ETFs at the moment. So Vanguard down here has 31 ETFs at the moment and about $70 billion invested in their ETFs. So they're by far the biggest. iShares has got a lot more. They've got 47 ETFs, but they've only got $43 billion invested in their ETFs. And then you come down to, BetaShares is now actually bigger than iShares, but still, nowhere near as big as Vanguard. And they actually have 91 ETFs. So quite interesting stats. So that's Vanguard, the biggest provider of ETFs in Australia. So let's take a closer look at ETFs and how they structure them up and what they offer to investors. So what I find interesting is they actually do have your own, like Vanguard offers like a personal investor, like your own brokerage account where you could buy Vanguard funds, pay zero brokerage, and then a flat $9 fee on sales. So that's pretty interesting. But for me, I don't just want Vanguard ETFs. I want to access the entire ETF market, but I just thought that was quite interesting. So let's have a look at their products. So here you've got, as we said, they've got, what did I say? It was 31 ETFs at the moment, and they'll probably be growing, bringing new ones on. So we'll start here with the diversified ready-made ETF. So these are quite interesting. It's kind of very much like your super fund where, you go into a super fund and you'll choose conservative, balanced, growth or a high growth type portfolio. And then they will then, apply that asset allocation for you. So you can see that's exactly what Vanguard does here. And they actually have quite a good range. There's also an all growth. So, just in terms of, let's have a look at the high growth here. And you can see that, it's got a really low management fee. As I said, the Vanguard funds should. But basically, this is what you want to look at, the allocation to growth assets. So it's 90% allocated to growth assets. Growth assets are basically shares and property, anything that goes up greater than inflation. And then they've got defensive assets, so that'll be bonds and fixed interest and cash. So that's the thing with the different allocations. So if you're balanced, you're going to have a small allocation to growth assets. Growth being more volatile, but a chance of higher return. So once you get down to conservative, you'll probably be at 50% growth and 50% defensive. And that's something that you do once you've built your wealth, and you don't want to experience all that volatility. You just want to live off the income. You start to dial down the risk. But when you're young, you can afford to take those higher growth options because you've got a longer term time frame to participate in that market and recover from any corrections. So in terms of that's 90 to 10 split, this is how they've allocated it. So it's still 36% Australian shares, 26% international. Then they've got a further 6% hedged. So hedged means that they take away the currency impact. So basically they're hedging it to the Aussie dollar and the US dollar. So basically if you're unhedged, like this element of the portfolio is, if the Aussie dollar goes down versus the US dollar, your investment assets will go up in value. But if it's hedged and the Aussie dollar changes versus the US dollar, you're only just getting the investment value. There's no impact of currency. So that's something to consider down the track. I mean, obviously the Aussie dollar has been quite weak compared to the US dollar over the last few years, but there was a time, it feels like a lifetime ago, when the Australian dollar was at parity and actually higher than the US dollar, just after the GFC. So, if we ever get a strong Aussie dollar again, you probably want to look at, before that move, you probably want to look at those hedged investment options. So there's fixed interest. So that's kind of that 10% makeup of the defensive assets. And then it's got international small companies and emerging markets shares. So obviously it's done pretty well over time. I think the other main thing to look at, obviously, low investment management fees. So the thing with Vanguard is that they will use their own funds within the asset allocation. So they, if you buy a Vanguard diversified fund, you'll get all separate Vanguard funds. So they, for their Australian shares exposure, they'll use Vanguard. International shares, Vanguard. So it's all Vanguard funds packaged up into a ready-made high growth portfolio for you. So that's the diversified high growth index, but obviously the same applies to all the others: conservative, all Vanguard funds, balanced, all Vanguard funds. Just the risk, the allocation defensive stocks is lower, and obviously it goes higher. All growth is almost 100% growth assets, but you can see low fees. So that's that kind of Vanguard model. But this, for me, these diversified pre-made, ready-made funds, ETFs, are perfect for the core element of your portfolio. So I like to think of it in that core and satellite mentality. So you kind of put, say, 80%. If you're quite conservative, you'll go, okay, I still want a bit of spark in my portfolio. I want to choose some stocks or choose some thematic ETFs. I'll put that in my satellite element of the portfolio. And for the core element of my portfolio, I'll just choose one of these funds. I'll just choose the growth Vanguard. I can't go too far wrong. That's going to be my core element of the portfolio. So if you've got a $100,000 investment portfolio, you might say, okay, I'm going to put 80% into my core, and that's just going to be the all growth Vanguard growth index ETF. And then I can choose with the other 20%, the other 20,000, I can choose some of these thematic ETFs. I might like AI, I might like, robotics or defense or gold, and I might add those other kind of ETFs as the spark in my satellite portfolio. So kind of like 80% into a core, vanilla, blue chip style, not too exciting, but won't lose you a lot of money. And then you've got your 20% in that $20,000 in those kind of other ETFs that can give you a bit of spark, a bit of return, and a bit of interest in your portfolio as well, just in terms of you managing it. So they're the diversified ready-made from Vanguard. I mean, these have kind of been game changers. We didn't have these, 15 years ago. So these are perfect. I mean, very hard to beat as well in terms of performance. I mean, most fund managers, I was actually reviewing quite a few of the super funds, comparing their growth portfolio to these growth portfolios, and they couldn't even beat them over the last 3 years. So that tells you something. fees matter, and these guys are pretty good at running diversified portfolios. Then we go down into the more specific kind of segments of the investment market. So we'll start here with Australian equities. So they've got quite a few Australian equities funds. So I think this might be one of the biggest ETFs in Australia. So VAS, and this is just an Australian shares index ETF. Super low fees, 0.07%. I mean, incredible. Very hard to beat, and fees certainly matter when it comes to investment returns. So that's Vanguard Australian Shares Index, and then they've got Index ETF. Then you've got ethically conscious Australian shares. You've got high yield. So this is a dividend-focused ETF, and that's actually done quite well over time. I've covered that in my dividend video. Once again, low fees, and you'll be very hard to beat picking your own dividend shares in terms of the time it takes versus just buying one of these pre-made ones. And certainly Vanguard isn't the only one that's got them, but yeah, they're pretty popular and they make a lot of sense for those seeking some income. Then you've got Australian large companies and you've got Australian small companies. So that's basically, that'll be the big blue chip, well-known names. And then the small companies tend to do better in a really good market. In a growth market, you want small companies. They're innovative, they're smaller, and just by their nature, they can grow more if they have a good business model. And, it's a lot easier for a $1 billion company to grow to $2 billion than it is for, a $100 billion company to grow to $200 billion. So small caps, that's, just Australian small caps index ETF. So they're the Australian equities ETFs. Then you've got international equity ETFs. So once again, they'll have quite a broad mix. So you've got, this is MSCI, this is just buying the entire world market. So obviously that'll be mainly the US. The US will probably make up 70% of that, but low fee and just a good general global, just give me a global international shares exposure. That's one to do. And then this is a hedged option of that. Then you go into your ethically conscious option. This is a Vanguard total, sorry about that, I pressed the wrong button. This is a Vanguard total US market. So this is S&P, NASDAQ, Dow Jones, all rolled into one. Just give me the total US market, and that's 0.03%. I mean, incredibly cheap. Here you've got all world. So this is the entire world outside the US. So that's actually quite interesting. I mean, it would have done quite well this year because this is probably the first year, 2025, first year in a long time that money's actually left the US and started, going back to Europe, back to Asia. So really interesting. Once again, super low fee. Then you've got your international small companies index. When the market's firing, small caps usually do the best. Then you've got Europe, Asia ex Japan. So Japan's obviously a very big market in Asia. Sometimes you don't want that Japanese exposure, so this is just Asia ex Japan. Then you've got emerging markets that'll take into account, Brazil, India, China, other parts of Asia. So that's your emerging markets. Then you've got global value, so that's kind of taking less of a growth tilt. So value investor, best known value investor in the world, Warren Buffett. This will, that kind of investment approach, looking for value as opposed to more high growth. And then you've got the global minimum volatility active ETF. So these actually been performing quite well. I've been looking at some of these volatility ones. So that's once again another international share exposure. Then we go down to infrastructure. So Vanguard has a global infrastructure index ETF. So that'll take into account, as it says here, toll roads, airports, rail facilities, public assets. So once again, that's just going to give you a broad exposure. When it talks about global, I mean, the biggest market in the world is the US. So you're probably going to get 70% US exposure in these type of things, these global investments. Then you've got a property fund. So you've got the Vanguard Australian Property Securities Index. So this will take into account Stockland and those type of companies, all those companies that also own assets, Goodman Group and things like that. So This includes retail, office, industrial, and tourism property assets. So this is Vanguard property, and property was in its heyday prior to the GFC. I mean, it's hard to believe, but pre-GFC, property was absolutely firing. That was where all the money was made. Since then, the listed space hasn't reached those heights again. But if you want some Australian property exposure, Vanguard's got one for you. And then you've got your fixed interest options. So these are the defensive. Remember when we looked at the high growth allocation, it was 90% to growth, 10% to defensive. So these are the fixed interest options that they use. So obviously you've got Australian fixed interest. So that'll be from any company in Australia, particularly the banks that want to raise money here. Corporate fixed interest, and also government, as well. Governments, banks. So this will be corporate fixed interest. So this is more the companies. This will be the banks. This will be the government. This is also, government bond index as well. So quite low cost as well, easy access to fixed interest. But my view on fixed interest at the moment is, I don't know, I just think there's a few issues there now with, over the last 20 years, interest rates have generally gone down, and that's been quite good for bonds. But finally, we've had inflation emerge and interest rates are going back up. So bonds are really underperforming at the moment. So be quite careful with that fixed interest exposure at the moment. But here's the other Vanguard options: global aggregate bond, ethically conscious bonds, international fixed interest index, and international credit securities index. So there you have all the funds from Vanguard. This is the biggest provider of ETFs by market cap in Australia. And these are all the options that they've got. We might just dig a little deeper into I'll just show you the Vanguard Australian Shares Index Fund. So just how I might analyse one of these funds. So we'll just go quickly through it. Obviously, we mentioned that before, 0.7%. That's pretty incredible. Very hard to beat. So this will give you exposure to the top 300 companies listed on the ASX. So we'll just go back and we'll see there are the top holdings at the moment: CBA, BHP, CSL, so all the blue chips, Westpac, NAB, another bank, and obviously it's done quite well over time. So yeah, pretty incredible. Easy access to the Aussie market, and I think, as I said, this is one of the biggest funds. I think it's got maybe 20 billion under management, so one of the biggest funds in Australia. So that's my summary of Vanguard. I hope you got some value from it. But I mean, that's basically how I look at these ETFs. We'll run through them, see what the options are. But Vanguard in particular, it's the largest. Obviously, the whole ETF space is going to be growing very strongly in Australia over the next few years as more and more investors seek to invest outside of Australia and get more of those investment options that we don't have in Australia. The thing about Vanguard is they don't have a lot of thematic ETFs or those sector ETFs. So they don't have like a cybersecurity ETF. They don't have a defense ETF. So those kind of satellite investments, you want to be looking at probably other ETF providers. But for your core, I think Vanguard are very, very hard to beat. But for the satellite, we want to be looking at iShares, Beta Shares, VanEck, Global X. All these guys are bringing out some really interesting and topical and thematic ETFs, and they've done really well they've certainly been the top performing funds over the last 3 years have been thematic ETFs. So keep them in mind. Watch my other videos. I'm going to be talking a lot more about thematic ETFs and the value that they can add to your portfolio, because I think a lot of Australians are really missing the value there. So that's my summary of Vanguard. I hope it helped. I hope it gave you a bit of a feel for what they offer in the ETF space. And I look forward to chatting to you again soon.